But now for the main event, it's my distinct honor to welcome Vice Chair Lael Brainard to the 64th NABE annual meeting. The conference is titled Shocks and Aftershocks, Finding Balance in an Unstable World. Dr. Brainard is undoubtedly and uniquely positioned to give perspective on this topic. The many, many luminous events in Dr. Brainard's career are many and too many to list today, but I thought I would just give you a little smattering of some of those experiences. A diplomat's daughter, she spent a childhood in West Germany and Poland. An undergraduate at Wesleyan University, a PhD at Harvard, and a professor at MIT. An advisor to Bill Clinton, including stewarding his policy and interactions with APEC, NAFTA, WTO, and the G7. Deputy Director at the National Economic Council, Undersecretary of the Treasury for International Affairs during the Obama administration, and she joined the Federal Reserve Board in 2014, and this fine year, she became Vice Chair. Please join me in welcoming Dr. Lael Brainard.
Well, it's great to be here at NABE, and I want to thank David Altig and Tom Beers for the kind invitation, and Lisa Emsbo Mattingly for the very kind introduction. Also just want to, as always, give a nod to Levon's amazing work over the years, and a shout out to the NABE scholars, the next generation. So nice that you can be here today. And of course, it's a great day to celebrate the Nobel Prizes, including for Ben Bernanke, who I think in the world of both research and practice put his work to good use. It's an interesting time. Inflation, of course, is high in the United States and around the world. We've seen global supply chains easing considerably, but they're still more constrained than nearly any time since the late 1990s. At the Federal Reserve, we have tightened policy strongly to bring inflation down, and that tightening in the US is being amplified by concurrent foreign tightening. And we're starting to see the effect on some sectors, but it's going to take some time for that cumulative tightening to transmit throughout the economy and for inflation to come down. And of course, uncertainty is high. So I'm paying close attention to global risks. So let me take you through each of those in turn. So higher interest rates are working to temper demand and bring it into better alignment with supply, which is still constrained. Output has decelerated this year by more than many had anticipated, suggesting that policy tightening is having an effect. Real GDP declined at an annual pace of roughly 1% in the first half. And over that same time period, real PDFP, private domestic final purchases, stepped down from a 6.4% pace in 2021 to an annual rate of only 1.3% during the first half. Recent revisions to the NIPA data imply that the current stock of excess savings held by households is lower and has been drawn down faster in recent quarters than had been estimated previously. Indeed, by some board staff estimates, the revisions imply that the stock of excess savings by households is about a quarter lower, which may imply a more subdued pace of consumer spending going forward. And of course, market expectations for the level of the policy rate at the end of the year are more than twice as high currently as they were just 6 months ago. And as a result, I expect the second half rebound will be limited and that real GDP growth will be essentially flat this year. The moderation in demand due to monetary policy tightening is only partly realized so far. The transmission of tighter policy is already quite evident in highly interest-sensitive sectors like housing, where mortgage rates have more than doubled year to date, and housing price growth has fallen sharply and is on track to be flat soon. In other sectors, lags in transmission mean that policy actions to date will have their full effect on activity in coming quarters, and the effect on price setting may take longer. The moderation in demand should be reinforced by the concurrent global tightening of monetary policy. In the labor market, we're seeing some tentative signs of rebalancing. For the second month in a row, growth in monthly payroll employment stepped down, slowing by about 50,000 to 263,000 in September. And in the JOLTS, there was a sharp over 1 million decline in job openings from July to August. The ratio of job openings to job seekers has declined to 1.7. By comparison, that ratio was about 1.2 prior to the pandemic. The sharp fall in vacancies at a time when initial claims held steady at low levels provides some support for the possibility that businesses that face significant challenges finding and retaining qualified workers following the pandemic may be more inclined than in past cycles to retain rather than lay off workers as demand softens. In particular, there's still a sizable 1.2 million shortfall in employment levels relative to pre-pandemic in the in-person services sectors. And those are the sectors that accounted for the majority of September payroll gains, suggesting businesses in those sectors may still be trying to catch up. A variety of indicators suggest labor demand is still strong overall relative to labor supply, which in turn remains below pre-pandemic conditions. The unemployment rate is now the same very low level that prevailed prior to the pandemic, and the volume of quits is elevated. The supply-demand imbalance in the labor market is reflected in strong wage growth. So if you look at the ECI, it increased by an annual rate of 6.3% over the second quarter, its highest level in decades. And of course, we'll have a read on the third quarter soon. A more timely data source, the average hourly earnings decelerated slightly to 4.4% annual rate over the third quarter, compared with 4.6% in the second quarter. While well above levels consistent with 2% inflation, wage growth nonetheless has been running well below current inflation. Strong wage growth, along with high rental and housing costs, mean that inflation from core services is expected to ease only slowly from currently elevated levels. In contrast, core goods have been expected to return to something closer to the pre-pandemic trend of modest disinflation as a result of demand rotating away from goods, coupled with the healing of supply chains and declining core import prices. Of course, that disinflation in core goods would be very helpful in offsetting the inflationary pressures in services. During the 5 years before the crisis, core goods made a small negative contribution to inflation, but that swung sharply into positive territory last year and had only started to step down somewhat in the middle of this year. So I think the surprise in the August inflation data was the large contribution of core goods inflation at a point in the post-pandemic recovery when many forecasts had anticipated this contribution would continue moderating. Since the pandemic, significant supply and demand imbalances have coincided with large increases in retail trade margins in several goods sectors. In some sectors, the increase in the retail trade margin exceeds the contemporaneous increase in wages paid to the workers in that sector, although that's not true in food and apparel. So the return of retail margins to more normal levels would meaningfully help reduce inflationary pressures in core goods, considering that gross retail margins are about 30% of total sales dollars overall. So among general merchandise retailers, for instance, where the inventory to sales ratio is about 20% above pre-pandemic levels, retail margins have increased about 20% since the onset of the pandemic. That's more than twice the increase in average hourly earnings. In contrast, in the auto sector, the real inventory to sales ratio is still 20% below its pre-pandemic level. And there we see the retail margin for motor vehicles sold at dealerships up by more than 180% since pre-pandemic. And that's 10 times the level of the increase in wages within that sector. So there is a lot of room for margin recompression to help reduce goods inflation, but that will depend on demand cooling, supply constraints easing, and inventories restocking. Despite the higher prices for a broad set of goods and services, market and survey-based measures of longer-term inflation expectations are within ranges consistent with expectations that inflation will return to 2% over the medium term. In order to bring inflation down and to keep those expectations solidly anchored at 2%, the Federal Reserve has increased the federal funds rate target range by 300 basis points in the past 7 months, and both market and policy surveys indicate additional increases through the end of this year and into the early part of next year. In addition, balance sheet shrinkage is now proceeding at its maximum rate, reinforcing the move to a restrictive stance. Broader U.S. financial conditions have tightened rapidly in response. The 2-year Treasury yield has moved above 4% for the first time since 2007, and the 10-year yield is near its highest level in over a decade. And we see similar kinds of moves in corporate bond yields, mortgage rates, and the dollar. Monetary policy tightening is also proceeding rapidly overseas. Many central banks in large economies have raised rates by 125 basis points or more over the last 6 months, and yields on 10-year sovereign debt in a number of foreign large advanced economies saw increases on the order of 190 to 360 basis points this year. The combined effect of concurrent global tightening is larger than the sum of its parts. We take into account the spillovers of higher interest rates, a stronger dollar, and weaker demand from foreign economies into the United States, as well as in the reverse direction. I'm also very attentive to the risk of further adverse shocks, for instance, from Russia's war against Ukraine, or China's zero COVID policies, or the pandemic. And we're also very aware that the cross-border effect of unexpected movements in interest rates and exchange rates, as well as worsening external imbalances, in some cases could interact with financial vulnerabilities. In this kind of environment, a sharp decrease in risk sentiment or other risk event that may be difficult to anticipate could be amplified, especially given fragile liquidity in core financial markets. In some countries, the realization of these risks could pose challenging trade-offs for policy. That said, the real yield curve is now in solidly positive territory at all but the very shortest maturities, and the entire real yield curve will soon move into positive territory with the additional tightening and deceleration in inflation that are broadly expected. Monetary policy will be restrictive for some time to ensure that inflation moves back to target over time. It will take time for the cumulative effect of tighter monetary policy to work through the economy broadly and to bring inflation down. In light of elevated global economic and financial uncertainty, moving forward deliberately and in a data-dependent manner will enable us to learn how economic activity, employment, and inflation are adjusting to the cumulative tightening in order to inform our assessment of the path of the policy rate. So let me wrap up there and we can turn to our discussion. Thank you.
Wonderful. Thank you. And I do have this wonderful little app that we can use to send questions. If you go into the NABE Connect app, you can send questions our way. And I think I will start it out with a fascinating panel that Elaine Buckberg, who's at GM, hosted. And I said she had actually curated it just for herself because it was about supply chain disruptions, energy, semiconductors, and labor. And she said, no, it was Chad Moutre, who's the chief economist for the National Association for Manufacturers, who had helped put the panel together. But my takeaway from that panel was, wow, supply chains disruptions are not probably going to go away. The tight labor market is not going to go away anytime soon. And certainly monetary policy is a blunt instrument, but what do you hope to see on the supply chain front that will give you confidence that it's starting to work?
So it is a really unusual environment with constraints on labor, on commodities, on key intermediates such as semiconductors, all interacting in a sort of perfect storm. And so we have seen just a less elastic supply response than I think we had all become accustomed to over several decades, actually. If you look at certain indicators, things have gotten a great deal better. Shipping times have gotten a great deal better, for instance. But if you look at some metrics like the Federal Reserve Bank of New York index, what you'll see there is a massive spike and massive easing to this point. But the point where we are currently is still above just about every year, with a 3-month exception since the 1990s. So it just gives a sense of how constrained things are. Of course, in the labor market, we are watching, very carefully. In terms of prime age workers, we have seen, month to month there's volatility, but we have seen a big improvement in labor force participation over the course of this year. We're within, about 30 basis points, about 0.3 percentage point of where we were pre-pandemic. But if you look at labor force participation more generally, we do have a large number of early excess retirements that were not earlier projected in the pre-pandemic trend. And it's hard to see. We just don't know how many of those people, there's a very substantial number, above 2 million, how many of those are likely to return to the labor force. Of course, there were also pandemic-related restrictions associated with immigration. So you also have a very large number of people that might have been anticipated as immigration flows had they been at normal levels. So probably we'll continue to see labor supply. We're sort of below a pre-pandemic for some time. And what do we look at? Of course, if you look across inflation, core piece or headline PC inflation, about a third of that, the overall, what is it, like six and a quarter, the most recent monthly, about a third of that is food and energy. That is almost entirely associated with Russia's war against Ukraine. So further shocks quite possible there. Then we see, another large amount that's in-person services. So that's about a third. There, I think the labor supply question that I was talking about earlier, how many people come back into those sectors and how much wages continue to grow there. And then the remaining third, you might divide between housing, which is a little sticky. And there too, you had a big demand shock with work from home. So there too, we had a big distortion. And so mortgage rates should help to cool demand there. And the remaining about a little more than a sixth is core goods. And we were talking about that earlier, where we still have supply constraints interacting with low inventories and sales ratio and high margins.
Great. So throughout our careers, we've had a lot of hand wringing over what has been called the dual deficits here in the U.S., the current account and the fiscal deficit. If anything, we're seeing a strong dollar dynamic. That doesn't seem to be an issue. However, should we watch with caution the experiences the UK has been experiencing? And are there any takeaways for us coming out of the UK?
Well, I'd certainly say the dual deficit story has not been, a good story for this cycle. First, we did see a very strong fiscal support during the pandemic, but actually we saw some of that saved. So we didn't see that in a corresponding big increase in the current account deficit. And likewise, we've seen as some of that's gotten spent out, we've actually seen an increase in government savings. So it's just worked quite differently, I think, than we've seen previously. And the current account has not been moving in the same direction. That said, of course, there are really important, just basic principles that we probably think would be wise to follow. And, one is right now, inflation is a very significant challenge for all Americans, particularly low-income Americans who spend 3/4 of their incomes just on necessities. And so we should have a, very strong, consistent set of policies that are focused on that. We know what we need to do at the Federal Reserve, and the more you have consistency policies working in the same direction, the more I think you'll see that process working.
So on the other side of that strong US dollar are our trade partners, Japan, the UK, China, the Eurozone. And we have seen central banks start to intervene in their markets to offset that rapid rise in the dollar. How is the Fed communicating and monitoring the impact of our monetary policy to our trade partners?
So we are very aware that we operate in a global economy and a global financial system. We recognize, very much that financial conditions in the U.S. transmit abroad, and that currency appreciation, while it may be disinflationary for the dollar to be stronger, the other side of that picture is that some economies who may also be working to contain inflation may be getting some inflationary pressures. We stay in very close contact with certainly with central banks around the world. And I think generally we all, with a few notable exceptions, most central banks are united in the fight against high inflation. And so most important there is just being transparent, predictable about what policies we're going to undertake to combat inflation. And I think that's generally appreciated. We also have regular interactions with financial stability authorities around the world, where we try to think about what those amplification channels, cross-border in particular, might be. And we also have fora in which monetary policy and fiscal policy officials talk. And so, we are very aware of, and also, sort of a lot of effort to communicate U.S. policies and potential transmission.
So now I'm going to start asking questions from the audience that have been upvoted. So if you want to get angry at me, don't get angry at me. Given long and variable policy lags, how do you calibrate the risks of the Fed over tightening?
Yeah, so we are very cognizant of, past history. And, we're aware that there are different kinds of risks in a tightening cycle, and the kinds of environment that we see currently, especially where supply disruptions have been prominent. There's a really important risk that inflation expectations could start to slip. And that would make the task of bringing inflation down much harder. So we've been very focused on making sure inflation expectations remain anchored, and it's clear that our policies are going to bring inflation down. And it's clear that monetary policy will be restrictive for some time. There is a risk, as we saw in the 1970s, of easing prematurely, and so that's why it's very important for us to be cognizant of that. But at some point, risks could become more two-sided. And there too, we have to be cognizant of those risks. And so there, I would say that by moving in a data informed, data dependent, and deliberate way, it allows us to learn about how the tightening that we're seeing here, abroad, and in financial markets is affecting inflation, employment, and activity more generally, and to take into account global risks in order to calibrate the path of policy.
You brought up a very interesting point, which is the scenario from the 1970s, which was easing too early. And so it loud and clear, data dependent. What are some of the sentinel data points that you're going to be looking for to tell you that you have gotten inflation under control?
Yeah, so in an environment like this, where you have a more complicated supply side of the economy with all the constraints that we talked about earlier, commodities, labor, goods, we just need to be cognizant of a much broader set of a bigger dashboard of data, if you will. So of course, I'm looking at the most interest-sensitive sectors, to see those early signs. And as I said earlier, you can really see the effect of higher mortgage rates on the housing market. It's moving very rapidly. But of course, we're also looking across less interest rate sensitive sectors like core services, and sort of looking very much to see what kinds of demand dynamics we might see there, as well as wage setting dynamics. So we're really looking across the full gamut. I'm looking very much at inflation expectations. I think, we had seen some deterioration there. Those now look really firmly anchored back in ranges that were characteristic of pre-pandemic. And of course, financial markets, to make sure that financial conditions are consistent with what we think the likely path of policy is.
Great. So there's a question which is sort of like you get to pick your favorite cause of the global inflation that we're seeing. Is it the COVID shocks? Is it the supply chain? Is it you mentioned actually excess savings? Is it the labor market? What is the core driver of the inflation that we're seeing?
Yeah, so I don't think this is a simple inflationary dynamic. What we saw was a sequence of very severe supply shocks, stemming initially from the pandemic, and then greatly compounded by the war that Russia has pursued against Ukraine. And the difficulty in that kind of environment where you see a lengthy sequence of supply shocks is that consumers and businesses might get accustomed to seeing higher inflation and might start to change their price setting behavior, their wage setting behavior. So I think I wouldn't actually say there's a single cause here. It was a combination of high demand along with a very protracted series of, in some cases, unrelated supply shocks that brought us to the very complicated place that we are at today. And I'd also say that, if you look across most of the large foreign economies, inflation is high throughout, even though the mix in each of those economies might be slightly different.
The introduction of QE following the global financial crisis helped stabilize the fixed income markets and the disabled financial sector. QE was again reinitiated in response to the dramatic dislocations we experienced during the COVID shock lockdowns. Today, the pace of QT has begun to accelerate. What are you watching? What are you monitoring to see if QT is progressing, if it's doing what you want it to do, and if there are any concerns on the QT front?
Yeah, so I think as we shrink the balance sheet, we have agreed a plan that will allow Treasury securities to roll off at about twice the pace of the previous episode of quantitative tightening, and MBS a little bit less than twice. And we expect that balance sheet shrinkage to reinforce the tightening cycle and the effect of the increase in the policy rate. But of course, we also recognize that liquidity is a little fragile in core markets. And so we're carefully monitoring liquidity conditions in those markets. We have now one past full cycle to look back on, which of course we didn't when we initiated QT the last time. So that's very helpful. And so I think we're better equipped with the particular market indicators that might have given us some signal last time around as we get a little bit closer to, that ample reserves regime kind of stabilizing point. But that's some distance in the future, but we are watching very carefully as we go.
All right. So I'm going to ask a question that came from the audience and got upvoted, and I'm going to add a little bit of an addition to it. The SEP suggests that the FOMC participants are comfortable with the terminal rate in the 4.5% range. What developments in financial conditions specifically would lead you to believe 4.5 might be too high or too low? And actually, I'll let you, if you don't want to answer it, that's fine, but.
So, I think that the summary of economic projections represents, all of the members of the committee's best effort to write down a forecast that's consistent with their projected policy path at any point in time. And then, of course, what you look at is the median of that. And most of the people in this room also write down forecasts. So that those are, very well informed by all the data to date, as well as historical relationships, but things can change. And so while, there's clarity that monetary policy will be restrictive for some time until there's confidence about inflation coming down, and the committee has taken quite strong action. And the committee's said that the policy rate will increase further. We also will be learning as we go, and that assessment will reflect incoming data and the sort of balance of risks domestically and globally. So I think it's very helpful at a point in time to get a sense of, where members kind of project the policy path to be going. But it's also helpful to remember that the actual policy path will be data dependent.
So President Evans gave us a little bit of his view on this question. But as we went to the zero bound, we introduced forward guidance to sort of create a more stimulative monetary policy despite hitting that zero bound. Now we're clearly off that zero bound. Is the SEP something we should continue to do? Is it doing what you want it to do? I won't tell you what President Evans said.
Yeah. So, I think it is important to distinguish between the SEP, which is again individual members' forecasts, and forward guidance. Again, we are we're moving in a deliberate way and in a data-dependent way, and so we are going to continue taking into account how the economy is evolving, what's happening with inflation, what's happening with the labor market as we go. So in that sense, I think there's been clarity about what our goals are and our resolve, and we've taken really strong action and shown that resolve. Inflation is going to come back to 2%. We're going to take necessary actions to get it there.
But in terms of exactly what the path of policy is, that's something that in my mind will benefit from the incoming data, as well as a sense of ongoing evolution of risks in an environment where I think uncertainty is clearly very high.
Absolutely. We've been through quite a bit over the last dozen years. We've had COVID, we've had a repo event, we've had lots and lots of shocks to the system. How do you think the reforms that were implemented following the GFC are doing?
Well, so critically important, I think that resilience in the banking sector was greatly improved following the great financial crisis. And you've seen the benefit of that as we've been able to stress test banks throughout the pandemic, and now, of course, coming into a war period. And that has, I think, both helped with market transparency, but also just the resilience of liquidity and capital at the core financial institutions, the banks. Now, we have seen more financial amplification outside of the core banking system. So, the NBFI sector was a huge source of amplification, both in the GFC and in the pandemic stress period. And so reforms there, I think, are ongoing, but certainly the visibility had improved somewhat. And the cooperation among authorities across borders and in the US across multiple regulators had improved a lot. So, I think what it suggested was we had made some really important progress, particularly on resilience in the banking system, but we still have work to do, and particularly outside of the NBFI sector, and including the most opaque parts of that sector.
Great. So sticky inflation, one of the biggest, stickiest parts of inflation is rent. And we are starting to see some significant slowdowns in the housing market, house prices, maybe even some inflection points on high frequency rent indicators. What are your thoughts on that part of inflation, coupled with maybe some of the challenges that might rise as we start to see some difficulties in the housing market?
Yeah, so the housing part of core services, I generally anticipate will be sticky. And in general, just based on past patterns, expect core services to be a sort of bigger contributor to inflation, in this period. And so that's why the focus on core goods would be so great, to see core goods playing more disinflationary role, which it could well do, given that core import prices will help out quite a bit there, and inventories are starting to get better. But within housing, I think the dynamics that you just talked about are exactly right. So mortgage rates have gone up a lot, and house prices are growing more slowly, and will soon are likely on aggregate to be flat. And in those parts of the country, you saw the biggest house price appreciation. We've actually seen some declines. What that means for rents, though, is a little bit complicated, because some people who might be first-time home buyers with these mortgage rates are not perhaps going to be renting longer, and so you might see some additional demand there. And as you said, while high frequency indicators of rent, may be starting to see a bit of a slowdown, which will be really important. Average rents take longer because those rents are only renegotiated slowly. So we assume there's going to be some stickiness in that housing services portion. Obviously, not as big for PCE as for CPI, but that's why it's important to see some less pressure elsewhere.
So just following on the housing market and actually this is the commercial MBS market. There's a question, does stress in the commercial MBS market due to higher rates cause concern for proceeding with balance sheet reduction?
Yeah, so I think feel pretty good about and has gotten off the ground so far. And of course, we're monitoring those markets very closely. As I mentioned earlier, we have a dashboard of indicators that we thought were particularly, with the benefit of hindsight, valuable in the first episode of QT. So we're monitoring that dashboard really quickly, really closely. So my sense is, so far, we're seeing the kind of absorption that you would wish to see. But we are aware that, this is a moment where liquidity is somewhat strained. And so we're going to remain alert to that possibility.
I love this question. The Fed's regulatory stress testing scenarios do not feature stagflationary scenarios. What do we know about our financial system's resilience to such outcomes?
Yeah, so I would say that, first of all, we have done a whole variety of different scenarios over the years, and we did have a bit of that flavor in the 2018 stress test. We learned a lot from those stress tests in 2018. The other thing is that, we have the ability to do kind of top-down exercises that are more just to inform ourselves what environments might be more difficult for banking system resilience than others. And so we're able to look at a variety of different kinds of environments in that, and we do. I think that is the kind of an environment where you see, interest rates going up by a lot more than expected and rising credit losses is a complicated environment with some offsetting effects depending on the business model of the bank. But we certainly, want to be aware of how that would play out. And so we do a bunch of internal analysis to just make sure we understand how different environments could affect different kinds of institutions.
So fair or not, some people have been dusting off their analysis of the 1970s to try to get a sense of what can the central bank do, et cetera. And certainly there's a lot of talking about Paul Volcker and what Paul Volcker did. A question I would have is, given the debt levels today in the U.S. economy, can we have another Volcker Fed with the debt dynamics that we have today?
Yeah, so I think when we think about the 1970s and then the 1980s, importantly, I think there are a variety of important differences and lessons. And I'll get to the debt point in a second, but what's different now? Well, first of all, I think there's a general understanding that monetary policy has both the capacity and the responsibility to get inflation down. That wasn't clear when the inflationary shocks happened in the 1970s. It's a very widely accepted tenet, and we certainly, we take it very, very seriously that we have the resolve and the tools. Another huge difference is that inflation expectations were unanchored in the 1970s. And so you saw some really toxic dynamics of high inflation becoming entrenched and leading to higher inflation. Again, we carefully monitor a whole variety of measures of inflation expectations, and we have seen those moving to ranges that were, prevalent prior to the pandemic, which suggests that, there is an understanding out there that inflation is going to come back down. So those are enormous advantages that I think will help with the fight against inflation today. In terms of debt levels, I mean, one of the interesting things that's different about this stress period, the pandemic, than perhaps past cycles, is that a lot of the fiscal support was actually used in ways that improved both business balance sheets and household balance sheets. So coming into this tightening period, you actually have healthier household balance sheets and businesses that have better debt servicing on average. And so that gives us a bit of a better starting point than you might have seen otherwise, because obviously those credit aggregates are very important for thinking about potential financial stability complications.
So if we think about the US corporate sector today, they are pretty close to peak profitability as a share of US GDP and income. And the CapEx levels that we've seen out of the corporate sector is actually pretty close to, all-time lows. Do you think that the corporate sector is going to be reinvesting to address some of the shortages, some of the labor market tightness, et cetera, going forward?
Well, so there, I think, obviously, in a rising interest rate environment, it makes it more difficult for some of those capital plans to be executed on. So we recognize there's that macro effect. But when we talk to businesses in different sectors at kind of the micro level, there's a lot of really interesting investment that is going on. Some of it supported, for instance, the semiconductor area and the energy transition area, both, supported by recent changes in law. So, my sense is there are areas where there's tremendous interest, and over a longer period of time, you'll see quite fundamental and important investments that will go to some of the challenges that the nation clearly faced during this last period, both on the energy front, on the climate front, and on key intermediate inputs.
We will end this discussion thinking about total factor productivity and how wonderful it is for the US economy, and the wonderful role that the central bank plays in making sure that we stay on that path. So thank you very much for taking some time with us.